Hey, all you everyday traders. This is Greg Jensen, CEO of Options Animal. Good to be with you once again, another episode of The Everyday Trader. I'm joined by my friend and partner, CEO of Trader Oasis, Eric Hale. How are you?
I'm fantastic. I don't know if I told you this. I got my purple belt in Brazilian Jiu-Jitsu on
You
my
know,
birthday, on my 60th birthday.
I think that is amazing. That is actually an awesome accomplishment. I did see your post on Facebook, but this is the first time you actually told me
Yeah.
live. So congrats. That's awesome.
Yeah, it's a kind of a big deal for me anyways. He took me 3.5 years, a lot of work. And yeah, I'm by far, I'm the next guy, youngest guy in there. There's a guy who's 55. He's a good friend of mine. Another guy is 52. And we kind of huddled together as the old guys because most of the people in our group are in their 20s and 30s. And there's some real badasses in here. And so not surprising, but it's weird. We get some guys from there's like 6, 7 guys from Moldova, and these guys all grew up doing sambo, which is like in high school, like you did football or whatever, or baseball, they did sambo. And so these guys, it's not jujitsu, but it's a lot of the same thing. The other category is we've got these guys from the stands, like Turkmenistan and Kyrgyzstan and all the stands, and they kind of look like meek, kind of this like Asian look to them, and they're very friendly. They're assassins. They have like a white belt or a blue belt because they just haven't been through jujitsu long enough.
So
But I hope what's
what's
that?
the next one beyond purple?
Brown then black. So
Brown then black.
yeah,
Yep.
black is probably 4 or 5 years away if I stay healthy and keep at it. Um, jujitsu is kind of like you don't necessarily, the professors usually do it based on, your scale. So while I'm a purple belt, there's blue belts that can just totally destroy me. So some of these other guys, and it's kind of like, well, given you where you're at, and how you've progressed. And so yeah, but
Well,
it's somebody came up to me afterwards. One of the young guys actually said, I read that if you have a purple belt, you could defeat 95% of all people in a fight. So I wouldn't test that out, but I feel confident that I
it's
can hold my
probably
own with
accurate.
most
It's
people.
probably accurate. And regardless, kudos to you.
Thanks.
That's a great accomplishment.
But
Uh
we're not here to talk about that. And what's going on with you? Get snow yet? How's
yeah,
Idaho?
it snows.
The Tetons? Yeah.
Tetons are beautiful this time of year. It's we're gonna get down into the single digits next week. So yeah, I live in the winter paradise. It's all right. I trade it because the summers here are it's the best place to be in the summer, hands down.
It is gorgeous for sure.
So I'll trade it.
Oh,
I kind of
guess
go
what?
into
I got some
hibernate.
news for you. I don't think I shared with you. And I don't know that I'm going to be able to go to the Teton Economic Summit, which is one of my favorite events of the entire year out there in Jackson Hole. And I'm not going to go because, or I don't think so. My daughter's pregnant and due.
Oh,
Yeah, she's
you
due
did
right
mention
around
that. So
there.
that's the due date,
Right around there. So
right around there.
right
Yeah.
around that due. We don't know the precise due date yet. So hopefully we get a little bit better. And yeah, so
You have all kinds of congrats going on to you today.
I
That's
know
congratulations.
it's
That's awesome.
phenomenal. Yeah.
That's awesome.
Yeah. Yeah. 2025 is shaped up to be a great year for me. Not looking like a great year for the market so far, though.
Yeah, especially as you talk about, as we got through our first week of January, the old Farmer's Almanac. Listen to me, Trader's Almanac.
The Stock Traders
The
Almanac.
Stock Trader's Almanac. The old saying is, as the first day of January goes, and then as the first week of January goes, so goes the rest of the year.
Right.
And yeah, January has not been very friendly to the market. We've had a lot of volatility. We've had big up moves, but mostly down as the markets have struggled. And we're giving a lot more of it back even today as we speak. Dow down over 500 points, and all three indexes. Well, four if you include the rut. In fact, the Russell 2000's down over 2% today, primarily on the back of the fear that inflation is back. As you and I have said for quite a while, it's never really gone away.
No.
Um,
Well,
it
is it inflation or it's more, I think it's more Fed policy. I mean, we don't have, we didn't get inflation data today.
No, that's true. Today's move is Fed policy, but I think the other behind the scenes stuff is the fact that inflation is going away. I mean, maybe
Oh,
it's and again, I'll share a little bit of my other life. I run a bakery. I own I bought a bakery for my wife a couple years ago.
this
Um,
episode brought to you by.
Teton sourdough. We're I still need to send you a loaf of bread, by the way. I've been
Don't think
telling you for a
I don't keep
year.
track of that. Don't
I've
think
been
I don't
telling you.
know.
But no, the cost of eggs have doubled. Again, the eggs are at all-time high. Chocolate is at all-time highs right now. The cost of producing a chocolate chip cookie at my shop has doubled in the last 6 months. So
What?
yeah, eggs are it's ridiculous. Anyway.
Your chocolate chip cookies, the pictures are just wow.
Yes. I wish I could take credit for it, other than all I've done is help her structure the business
Are they
model.
sourdough chocolate chip cookies?
They actually are sourdough chocolate chip cookies. So they're
In the
good.
soups. What's your favorite
Anyway,
soup?
my favorite soup, clam chowder.
Clam chowder.
I like clam chowder.
Clam chowder. Every time I think of soup, you know what pops in my head? Do you remember the episode of The Office? Creed comes in and says, "Somebody making soup." Do you remember that episode?
I don't. I need to go find that one.
Oh, it's maybe not.
All
I'll
right.
leave it
So
to
sorry,
The
we
Office.
got
Yeah, with diatress. Okay. So come
back
back to
on
this.
track. Back on track. Market.
Market. What
Um,
is going on in the market? So do you think, I mean, I've been saying all year, or at least since, December, we are not necessarily seeing, there hasn't been any major announcement that would be a necessarily a pivot. My sentiment personally is bullish. I think there's a lot of reasons to still maintain bullish, even though we've had these absolutely two record-breaking years in a row. I mean, what's happening right now does not seem like a pivot. We've seen concerns about a bunch of different things, and you and I wasn't disagreeing with you about inflation because you know that I'm in the camp that inflation is real and gonna come back. Um, and going to be, tariffs and employment policy. Although Guy had shared something this week about how if you think about supply and demand from an economic standpoint, that if tariffs increases the price, that it doesn't just there's a supply, there's a demand side of that, and there's price elasticity. So if the price of things go up, if the price of chocolate chip cookies go up, do fewer people buy them, Greg?
it depends, right? If they've got money to buy it with or not. If they've got money, then sure, they'll still buy it, until they feel the pain of I'm giving something else up.
But
Uh,
what would happen if the prices went too high? People would stop buying them, and then Greg would have an inventory of eggs and chocolate chips, which nobody wants to buy. So then your choice would be to discount the prices,
yep.
which is deflationary because you've got spoilage you've got to be concerned about. And this is Guy Ed's piece that he wrote. Somebody emailed him that if you think about the just going back to economics 101 supply demand curve, that if we raise prices, suppliers have two choices, and that is to either cut their margins or raise their prices. And it could affect the whole supply imbalance. And he actually makes an argument that there's a potential it could be deflationary long term. Tariffs could actually be deflationary. And I would just say that it's a dynamic. Economics is called the dismal science because nothing's ever completely clear. And the dividing line seems to be on whether tariffs are inflationary or deflationary, seems to align pretty clearly with your opinion of the, the new president from an economist standpoint, anyway. So it's hard to get a clear picture of what's going to happen. And I think that's the biggest thing is that there's uncertainty right now. We did get clarity. And the reason why the market moved today, we said Fed policy. It was one step away from Fed policy, and that was the jobs report, which was incredibly strong. We had a very, very strong number, blew all estimates out by over 100,000. We added 256,000 jobs in December, and the unemployment rate dropped down to 4.1. And these numbers are a little bit choppy. The ADP report came out strong this week earlier too. So this is a bit of a concern because when jobs and unemployment goes down and you're adding more jobs to the economy, you tend to have a hotter market. And we've got a dichotomy going on right now. We've got the Fed cutting rates, which is stimulative to the economy. That helps people get jobs. It helps grow. Um, makes the cost of doing business cheaper, which is stimulative. So we've got a mixed messages even within the Fed. Bowman coming out saying that she'd be okay with us cutting rates, and then Waller earlier this week. I mean, she'd be okay with us holding, and Waller coming out saying that he expects that we're going to continue to cut rates. So, what are your thoughts on that?
Well, I don't think it matters what the Fed is doing right now. I shouldn't say that. It does matter, but it doesn't seem to matter to the bond market. Since the Fed has started cutting rates, we've seen the 10-year yield go from 3.6% in September um, to now almost 4.8.
I'm glad you brought that up, Greg. Like, is that how you would expect?
No, no,
Okay,
the
okay, because
exact opposite.
I'm scratching my noggin on this. I know I'm not the smartest guy in the, but like if the Fed is cutting rates, shouldn't yields be coming down?
They should be, but yet that's the problem is they're not. And so there is, and whether this is there's too much money um, still in the system and they're trying to find something, but there's obviously some selling going on in the bond market. That's what's causing yields to go up is bond sales are happening. But we're seeing that in all rates. The 30-year is up to 5% again. The
Greg, I got a chart real quick I want to show, and that's so this red line is the Fed funds rate, and the blue line is the 10-year Treasury. This is the yield on a 10-year constant maturity Treasury. So it's seeing these, it doesn't normally work this way. They normally would move together, and seeing the effective fund rates come down and as you say the 10-year Treasury going up here um, to multi-year highs. This is, or I guess this is not quite multi-year high, but 1 year high. It's not what I would expect. It's not textbooked. There's something else
Well,
going
and
on.
to me, it's maybe a red flag that something is broken in the market for that to be happening, because you're exactly right. It should be the bond market should trade, doesn't have to be exactly in line with what the Fed is doing, but it should at least be in the same direction. We shouldn't be seeing the Fed cut rates. And again, unless the bond market and the demand, all of the supply and demand inside of the bond market is telling us that the Fed is wrong. That in spite of them cutting rates, the demand is clearly for higher yields. And that's what could be inflationary. But that's what could be the inflationary pressure behind all of this. It'll be interesting to see what happens in the mortgage market again. Mortgages, the 30-year average fixed mortgage just peaked back up above 7% again today. It got there a year and a half ago, I think middle of 23. We peaked up above 7, and that was kind of the top. And then mortgages got cheaper again. We saw demand for homes start to come back up. But now we're back up above 7% again. And will that have the normal supply and demand uh, example or consequences where if we see rates on homes continuing to go up, that demand to buy homes starts to slump. We haven't seen it yet. Home prices still are going higher across most of the nation. I know there's spots. I know Texas has a few areas that are kind of weak. I think there's a little bit of weakness in Florida right now in the housing market, but for the most part, home prices continue to go up. And I think on the back of that, we have good jobs, we have everybody's got money in their bank accounts, their 401ks are essentially at all-time highs, and that's what's continuing to drive this economy forward and drive, I think, the fear of inflation. So why is the market reacting so negatively to a bad jobs report? My only answer I can say is it's got to be this fear of guessing that the Fed's next move is probably going to be to cut or to raise, and that the cutting game might be over.
Yeah, but unfortunately, I'm not surprised by this. I mean, this is, I guess it's taken a while to come around, and um, I don't think anybody would paint the picture of, this is the current situation. Here's where GDP is. Here's where um, you know, unemployment is. Where Fed policy is. What do you think is going to happen? I don't know that people would be picking where the treasuries are. And also, I wanted to throw in the U.S. dollar strength. This is the Dixie index, and we're at a 1-year high. We're I don't know what our audience knows about the U.S. dollar being strong. Unless you're planning a vacation to Europe, a strong dollar is not good for the United States. So I've heard Donald Trump say, yeah, strong dollar, yes. But I think that's because he probably plays to people who associate the U.S. dollar with the American flag. And it's like, we're strong, we're a good company. And Trump is definitely a weak dollar guy. It makes our products more attractive to other countries. So that's a strong dollar. We've got a confluence of things that are happening. So strong dollar tends to be bad for the economy because people forecast, that there'll be less demand. The other thing on the treasury yield, we talked about the treasury yield going up. If you're getting 4.67% on a 10-year treasury, at some point somebody says, you know what, there's no risk in that. So why should I invest in the stock market? I'll just put my money back into treasuries.
Yeah.
And we're starting to see that. So we've got a confluence of things that are happening, and I think explaining why the S&P 500 is pulling back a little bit. I'm not ready, although we do have technical bearish signals here on all of the MACD, the RSI, the moving averages are all telling us that the trend is now bearish. I'm not ready to call this a bear market. I'm looking at that 5,800 level as a significant level of support. And if we break through that, I think, then we're down to 57 and then we're down to 54. And who knows, maybe we get down into the 5,100 area on the S&P 500. So right
Well,
now
it's
the
interesting.
trend is definitely bearish.
Well, yeah, and just again looking at charts, you're right. I think 5,800 is a pretty important level, and we went down and almost touched it even this morning.
Yeah.
We were at 5,807 as the low today. So we're trading what around 58.44-ish right now. 58, sorry, almost 58.50. So we're a full 40 points off the low of even just today. So I agree with you. I don't want to call it a bear market yet either. And to be honest, to zoom back even further, I mean, you look at that chart and you have to say, yeah, it would be maybe a little bit healthy, even if you're still in a bull market, still in a growing economy, to say, yeah, this market could correct a little bit and have some profit taking. You and I talked about this before the end of the year last year that we didn't expect there to be the normal tax selling pressure at the end of the year, at the end of December,
Yeah. We
because
expected
there
it to happen at
wasn't
the
an
beginning of the
incentive.
year. Yeah. So why would you sell something that's at a 52-week high and pay taxes on it in December when you could just push it off to January? So
Especially if you have an incoming president who's more likely to extend favorable capital gains rates, as that's been his policy the entire time. And so it would make more sense to hang on and sell in January at your 52-week high than it would to sell before the end of the year. So I think that could be what's going on right here in January as well.
let me share let me share a chart that'll probably make people feel better. So that this website here, equityclock.com, does seasonality charts. So this is starting from January 1 to December 31st, what happens on average. And this is where we are in January. So just January is pretty much a nothing month in general. It's a flat. This is the S&P 500. What typically happens in January,
That's kind of
and
like living in Idaho in January.
nothing
It's
happens.
kind of a nothing. You just kind of hunker down, you survive, and wait for the summer.
In the springtime, and then you see your neighbors. You don't
Yeah.
actually see them because everybody's in the garage and to the car. So we'll get a what's status or what technical people would refer to as a head fake in February. So we'll get a rally in February, and then we'll give it all back up, and then March everybody will be depressed, and then spring comes, and yeah, so hopefully in March, this, I mean, looks like we're gonna have this is what typically happens in the beginning of the year. So I'm not ready to throw in the towel and say we got a bear market yet. The other piece of data that I wanted to show, and this one we shared a lot last year. This is a chart of this is published by Goldman Sachs, but I've seen the same chart by other people. And this is what happens to the market before and after a Fed when the Fed starts cutting rates. So this is the date of the first rate cut, and these are months before and months after. And you'll see three distinct charts here. The dark blue line is on average what happens. So the market tends to kind of chug sideways. But if you break that down into do we have a recession or do we not have a recession? And if we have a recession, the market tends to pull back. And even here, it's showing 10%, which is not a bear market. But if we do not have a recession, this is the chart we're in. And listen, this is what and you look at sort of chopping sideways here for the beginning of it. This is where I think we're going. I think we're going to have a great year. I think there's going to be buying opportunities here. And, I'm willing to change my mind when the data changes and the market moving. It just, I think you mentioned earlier, it's just normal volatility. And I think it's just normal volatility. I know you tend to run a little more bearish than I do, but do you have different thoughts here?
No, I don't. I'm of the same opinion that unless we see something pop the bubble that we've been inflating, um, which I don't foresee. And the jobs report today was a good piece of data. It says that the people still have jobs. That means they're still going to be contributing to their 401k, which means they're still going to be putting in that automatic money that's going to invest in the S&P 500
Michael
and still,
Green. Yeah.
yeah, push assets higher. So as long as jobs say, if we stay employed and there's people still have money in their checkbooks, we're going to spend it. Companies are going to hit earnings. We're going to see stuff grow. It's until we see something that causes job contraction and job loss, then I think any dip is probably an opportunity longer term. Now, I don't think this bubble will last forever, because I do still think there's a lot of hype, there's a lot of perfection priced into stocks right now. And when you see companies that are trading at really insanely high PE ratios, and the interest rate starts to climb, that can cause some pain in that specific sector. A lot of people try to say, well, these stocks are not interest rate sensitive because they don't have any debt. So why does interest matter to them? That's not how stocks are formulated. That's not how the average price of a stock is calculated. If you go back to your fundamental analysis and research, a stock's price today is based on a discounted future cash flow. And that's when you have a company that's got all of these future years of cash flow priced into them, today's price. If all of a sudden the denominator, a part of the denominator, that interest rate component is going up, then that price today is going to have pressure to the downside. So higher interest rates can cause high PE stocks to have pressure to the downside, even if they don't have debt. So be careful to be, lulled into the idea that, oh, they don't have debt, so they're not exposed to higher interest rates. That could put some pressure on certain sectors, but I think the overall market, not everybody fits in that. I mean, let's be honest. The last 2 years, the last 5 years have been driven by the Mag 7. So those stocks trade at pretty high multiples. They may be a little bit more pressured. if we see really high interest rates. But I think the overall market can survive higher rates for a while too, as long as we keep the economy going forward, and people employed, and we don't see those employments change. So I think you can still be optimistic on certain sectors. I'm a little less optimistic to jump out and buy Nvidia right now. It's just off its all-time high still, and does trade at a pretty high PE. I know they're a fantastic future company, but I'd maybe wait to buy it on a pullback rather than buy it at its all-time high right now, or just off of its all-time high right now.
I just wanted to back up a little bit, go back to your PE ratio. And so there's two PE ratios, as you mentioned. There's the actual earnings, but most stocks are priced off of futures. And a lot of times people look at the PE ratios, and this is going back to the 1800s. How we got the PE ratio in 1870, I'm not quite sure, but we did. And apparently, this is Schiller's website. You can find this as multpl.com, and these are the PE ratio. And so right now, the PE ratio, this is looking at 12 months behind us. It's very high, but as you can see, we've been higher in the past. So there's room for
Yep.
concern, but it's not like we're up in the 40s or somewhere crazy. But if you switch to forward earnings, this is from Guru Focus. This chart's a little bit wonky, and we've got this really crazy COVID thing, or this is the global financial crisis. But if we look at where it is, we're not too far away from the norm here. And this is plus or minus one standard deviation. So this is based on forward estimate of earnings. And it's not crazy, and the trend is going down. So I'm in the camp that this market could have more to run, and that based on a fundamental estimate here, that we've seen earnings growth, and we're coming up on earnings season, so everybody should be prepared for what earnings season means to your equities. You're probably going to see some big changes, and one of the trends that we've seen here over the past couple of years is that earnings tends to be the movement on earnings has been bigger than historically. This is one of the things that Goldman Sachs has been sharing some of their option volatility research showing that stocks have been moving more. So for those of you that have stocks with earnings coming up, as you and I talked about, things that cause anxiety is not having the proper trade in place for earnings could be a thing that could lead to a source of anxiety. Uh, how do you handle that?
Options, right?
Options. The
Options.
collar trade.
Yeah. Understanding that there is a way to not only control risk, but to actually optimize your profitability.
There's
Is
there's
understand
this
how to take
gambling
advantage
thing.
of it.
Guyed and I talked about it. You were there too. We talked about it with Guyed, is that there's this perverse gambling that's going on with a lot of people. And some of you listening to us probably are in that camp. That's like we're these new leveraged ETFs are crazy, and people are doing options on these leveraged things that just leverage is what was it? Did Charlie Munger say there's three things that'll make you go broke? And something was ladies, alcohol, and leverage, or something like that.
Yeah.
Ladies, liquor, and leverage. I think it was the three L's.
Yeah.
So be very careful. Greg and I approach option trading from a really conservative standpoint. Greg has really mastered this thing called the collar trade, which is boring, but being able to be cool as a cucumber over earnings, knowing that, hey, listen, I can make money no matter what the stock does. Stock goes down, I'll make money. Stock goes up, I make money. This is not every kind of collar trade, but certain kinds of collar trades. And being able to, you give something up, like if the stock has a huge move up. So let me ask you a question. So if the stock goes up and you make money, are you okay with that? And if the stock goes down, you make money. Are you okay with that? Yeah. Well, if the stock goes up a lot, you won't make as much if you didn't do this. But you say, well, but I knew that I would make money if it went down. So I'm okay with that. And maybe you're not, but some people are. So options can be used to hedge your risk. And it's important for people to realize that it's not just gambling. We were talking earlier about some of our friends that we know. And Barry Ritholtz um, might be coming on. He said he'd be open to doing an episode with us in the future. So maybe we get Barry on here. And Barry, I mean, I've talked to Barry, and I know he sees, let's say, option traders get a bad name because there's a few people that probably make the rest of us look bad. But us quiet ones that are not out there doing crazy stuff understand that options are tools to be able to mitigate risk. That's really yes, you can gamble with them. Yes, you can get huge return, but there's a large fraction of you folks out there that are serious people and would love to be able to go into earnings saying, no, I'm not going to lose money. Or if I lose, it's just a little bit. And that lets you sleep at night.
Well, and I'll throw one more caution on there, especially in today's environment of YouTube. You know, here we are recording for YouTube and posting our own show. And, you know, there are a lot of gurus out there with YouTube channels who have popped up in the last 3 years since COVID, of how good they are at trading options. And I'm not saying that their gains are not legitimate. They probably are, because let's be honest, since COVID, the markets have gone straight up. We had a little bit of a pullback in 2022, about 20%, which is a pretty standard bearish correction inside of a bullish market, but the market has gone straight to the upside. And it's been pretty easy to make a lot of money, especially if you've been using leverage in options, because the markets have been very, very bullish. But I've seen this play out before more than once, where the guru who has made a ton of money while the market's screaming to the upside, and when the correction happens, they go from extreme amounts of money to zero, not just losing a little bit of money with the rest of the market, but their accounts completely blow up. They lose everything and then some in some of the sad cases.
You know
Uh,
what this is? Goes from 2 cents to 152.
2 cents. Oh yeah, fart coin. There you go. There's another example. Be careful in using leverage and following a lot of these self-proclaimed options gurus who know how to trade and read option flows and show you all of this data. Honestly, folks, most of them are just trading a bullish market right now. And they're out there buying calls on momentum, and momentum is your friend until it's not, and then momentum kills you, and it kills you a lot faster than it makes you money. So make sure you understand risk management. To me, that's the most imperative thing I can help you learn. That's what both of our companies, Options Animal, Trader Oasis, are structured around, is teaching you how to manage risk, still use those options, understand them, so then you can be successful long term, not just for the 2 or 3 years that the market's on a bullish tear, and then you give it all back when we have a correction. All right, I'll get off my soapbox. All right, Eric. Anything else before we wrap her today?
No, it's good seeing you.
Okay, good to talk to you too. We'll
And the rest of you, thanks for being here. We appreciate your feedback and comments, and like and share. Share with your friends. Subscribe, and provide feedback. We're here to help you guys. So thanks for
thanks
everybody
everybody.
taking time out of your day and spending it with us.